On today's episode, we look at an industry Wall Street is going crazy over. Forget stocks or crypto. The hottest investment right now might be something less flashy: private credit. Investors are pouring billions into this space. Big banks are hiring hundreds of employees for their private credit divisions, and industry leaders are calling it one of the biggest opportunities in finance. But what exactly is private credit, and is it really all that it's cracked up to be? Let's break it down. What is private credit? Simply put, private credit is lending that happens outside of traditional banks. This can include a variety of things like providing emergency loans to struggling companies or buying up debt from consumers with bad credit scores, also known as subprime debt, or making loans to businesses that can't get funding from traditional lenders. In essence, private credit is all about making money by lending money to people or businesses that are considered too risky or too complicated for traditional banks. Why is it booming now? There are several factors fueling the boom in private credit. First, interest rates have been on a roller coaster ride since the pandemic. As a result, many investors are looking for new opportunities to put their money to work and earn a return. Private credit offers just that, the chance to earn higher yields than traditional investments like bonds or savings accounts. Second, big banks have been scaling back on lending. With increasing regulation and tighter banking rules, banks are becoming more cautious about who they lend money to. This has left a gap in the market for private credit funds to step in and fill the void. Finally, there's a growing demand from businesses that need access to capital but can't get it from traditional lenders. This could be due to a variety of reasons, such as a lack of collateral or a history of bad credit. But whatever the reason, these businesses are turning to private credit funds for help. All of this has led to a perfect storm for the private credit industry, making it one of the fastest growing areas of finance today. What are the opportunities? The private credit market offers several opportunities for investors and lenders alike. One of the most attractive aspects of private credit is the potential for higher yields compared to investments in the public market. Private credit investments can offer yields of 8 to 12% or more, which is significantly higher than the returns available on public debt. Another opportunity lies in the strong demand from companies that are unable to secure traditional bank loans. This opens the door for private credit providers to offer much-needed capital to businesses that might not have other options. Additionally, the private credit market is relatively new and still has a lot of room for innovation and disruption by fintech companies. This means that there's potential for those who are willing to take risks and experiment with new technologies to come out ahead of the competition. What are the risks? While the opportunities in private credit are enticing, it's essential to be aware of the risks involved. One of the biggest concerns with private credit is the lack of regulation compared to traditional banks. This can make it more difficult for investors to assess the risk of a particular investment and may lead to more defaults or missed payments. Another risk to consider is the potential for credit defaults. If the economy slows down or certain industries underperform, it could result in borrowers defaulting on their loans. This can be particularly problematic if a private credit fund has a large exposure to a single industry or borrower. Finally, the private credit market requires specialist expertise to evaluate deals and manage risk effectively. Many investors don't have the necessary knowledge or experience to navigate this complex market successfully. What does this mean for viewers? For professionals working in finance, the rise of private credit means new job opportunities and high demand for skills like credit analysis and risk management. Compensation is likely to be high as the industry seeks to attract top talent. However, it also means that employees will need to keep up with the latest trends and technologies in order to stay competitive. For investors considering private credit funds, it's important to do thorough research, diversify their portfolios, and be prepared for potential risks. Don't fall for the hype. Look at past performance. fees, and the fund's strategy before investing. To recap, private credit is emerging as the hottest finance trend in the US right now, attracting capital, talent, and attention on Wall Street. But is it really all that it's cracked up to be? Only time will tell. Do you think private credit is the future of lending, or just another bubble waiting to burst? Drop your thoughts in the comments. And don't forget to subscribe to Profit Path for daily insights into stocks, crypto, and the biggest finance trends. Thanks for watching. See you back here tomorrow.